Hi, everyone. Thanks so much for checking out my show, Coin Stories, where I get to hear from the leading voices in Bitcoin, financial markets and investing, political structures, philosophy, and more. Please make sure you're subscribed to the show. And if you're watching this on YouTube, like the video so more people see it, and hit that notifications button so you don't miss out on any new content. This podcast does not provide financial advice. It is for educational and entertainment purposes only. So make sure to do your own research before making any investment decision and be aware of your risk tolerance. I'm able to produce this show thanks to my sponsors, and I'm very picky about who I choose to partner with. So I hope you take the time to listen to the ad reads throughout the show. All right, now to my first partner, where I buy my Bitcoin, Swan. I'm proud to partner with Swan because it is a Bitcoin-only company focused on helping people save for their future and self-custody their Bitcoin, not trade it. Swan offers a private client service, retirement planning, tax loss harvesting, and even home equity conversion. Swan is also committed to educating millions of future Bitcoiners through free educational resources and media projects. I actually use Swan to dollar cost average every day. I deposit a little bit every day that's equivalent to what I might spend on a meal because I actually read that dollar cost averaging daily ends up with a lower cost basis than weekly or bi-monthly at the end of a given year. Swan also produces my show, Hard Money, which reports on Bitcoin adoption and macro trends around the world. So make sure to subscribe to that as well. And to learn more and get $10 in free Bitcoin when you sign up, head to swanbitcoin.com/Natalie Brunell. All right, next up, Bitcoin Conference 2023. This is the ultimate Bitcoin event every year, and it's going to be held once again in Miami Beach, May 18th through the 20th. Last year, there were about 30,000 attendees, and it's hard to believe the scale until you see it in person. There are incredible speaking sessions featuring the world's biggest Bitcoin voices, networking events, games, parties, and of course, Soundfest. I actually credit my career transition to the Bitcoin conference because I went for the first time in 2021, and that's where I dropped my first episodes of Coin Stories, not expecting this to become my full-time job at all, but just hoping to meet Bitcoiners and find more guests for the show. I actually went up to people like Michael Saylor backstage with a business card, and that's how I got him to come on the show. So anything can happen there, especially if you dream of working in the industry. Ticket prices go up every month until May, so don't miss out. And for 10% off, use the code HODL at b.tc/conference. I'll see you there. James, I get 21 minutes with you.
In a row.
I'm really excited. Well, first of all, how do you like Wyoming? How's your ski summit going?
I have loved being up here. I grew up in the Northeast, and I haven't seen snow like this in many years, and so it's been a lot of fun.
Well, a lot of people that watched our other interview where you shared your backstory, they know that you had an injury from your years as an athlete, so you're not skiing.
I'm not even skiing. I've done
a lot of work.
You can't risk it? I've had a lot of meetings. It's actually been incredible how many people I've met with here. They're some of the most intelligent people in the space, and it's been fun. So I haven't really missed the skiing. I'm glad that I'm not out there getting injured.
Well, I know that you are here working on spreading the message of the Bitcoin Opportunity Fund, right? That's what you've been working on lately. So for people that haven't heard about it and what that is and who you're working with, what can you share?
I can share a little bit. It's an investment fund that's for accredited investors. So, but what we're doing is we're looking for opportunities anywhere in the Bitcoin space, and there's been a lot of damage in that space lately. And so I've teamed up with Greg Foss, Larry Lepard, Mark Moss, Corey and Swan, and David Foley, who's my co-managing partner. He and I are going to be doing the portfolio management and day-to-day stuff. So, and we're looking for opportunities in the space, and It's funny there when you see a sale at Walmart or at Target, people rush in. They actually get in fights over TVs that are on sale. But when the market is struggling, especially in the crypto space, we've had a lot of bleed over from the FTX and Celsius debacles and contagion into the Bitcoin space, even though Bitcoin wasn't the problem. So there's been a lot of damage, and there are companies who need money, and we can help. So our fund is it's a public and private hybrid hedge fund, and so we can invest in both public companies or private situations. It could be early stage, late stage. We could buy assets in distress from companies and say miners and plug them into power that we can own, or we could buy anywhere up and down the capital structure of a company and then use hedging strategies to limit and minimize the risk. So that's what we're doing, and we're excited because we feel like this is the best time to be doing it, with all the distress in the space. This is the right time to do it, so we're excited.
Well, I know a lot of people are familiar with mining companies that have had solvency and liquidity issues, but what are some other examples of companies? Because I know even last night when we were at dinner, Greg Foss mentioned this includes shorting, the Western Union. So there are a lot of different investments.
Yeah, so we can short traditional financial companies that we feel are not keeping up with the digital movement, and so exactly something like Western Union. I'm not going to say that we're going to do that, but that's something that we would look at. We can use hedging strategies. We can use put call strategies. We can, for instance, if a company that's a public company that's struggling and needs money, or its bonds are trading down, we could buy those bonds and short the stock. We can borrow the stock and short against it in what we call a delta hedge in order to isolate that opportunity. What we're trying to do is get to the opportunity and hedge out as much of the risk that we don't want to take on out of the investment. So we can do things like that. It's a little bit unique in this space right now.
That sounds really exciting. Well, I want to talk to you a little bit about macro, because in your newsletter, The Informationist, you do such a great job breaking down what for many people is very complicated topics, everything from how the Treasury functions. And I know you're going to be maybe doing one on something I'm curious about, stock buybacks. Yeah. So first, before we get there, what's your take on just what's happening with macro? I know, the Treasury's increasing borrowing in Q1. Things haven't, quote unquote, broken and forced a direct pivot yet, but things have broken. We've seen it over the last couple of months. So what's your overall take?
Well, I mean, you can't look at the macroeconomic landscape without focusing in on the absolute mountain of debt that is hanging over the entire sovereign world. So all of these sovereign fiat currencies that issue their own bonds, they have so much debt, and that's been a major problem. And like you're saying, we've seen things break. We've seen Japan and their just relentless yield curve control, buying their own 10-year treasuries and monetizing those. The Bank of Japan now owns more treasuries than any other private holder in the world, and their own treasuries. They own over 50% of them. So we saw what happened in the UK this last fall with the pension funds. They're chasing yield because it's difficult to get yield when you have 0% interest rates, ZIRP, right? That zero interest rate policy. So everybody's chasing after yield, and with all the debt, that just levers every single institution to be damaged if there's a sharp move in interest rates, and it's exactly what happened. So that happened there. You're seeing indications that there's going to be a credit event. So when you ask, like, what am I looking at? And you often ask me that question. I'm watching for that. I'm watching the treasury auctions. I'm watching liquidity. I'm watching to see if there's any sign of this coming liquidity event or credit event. But it could be Credit Suisse. It could be another company, and that contagion will bleed over and cause some massive pain in the debt market. So,
do you think it just hasn't happened yet because there was so much liquidity in the system? Because we weren't even this far in debt in 2019 when everything locked up in the credit markets and forced, the printing to accelerate. So, I mean, why have we been able to kick the can down the road?
Well, I mean, there's so much trust in the fiat systems, right? So the Japanese yen still, there's trillions of dollars trade in currencies every single day. So there's a massive amount of trust there. The U.S. gets a big pass. The Treasury gets a big pass. And so even though we are operating at a growing deficit every single year, the U.S. dollar is the reserve currency of the world. The U.S. Treasury is still the reserve asset of the world. So the global reserve asset. And so we get a pass on that. And so what the Treasury is doing, and they know this, and what the Fed is doing is they have to keep inflation down to a point where it just doesn't get out of control, right? Because you can't lose confidence in the currency, because then you lose confidence in the asset, the Treasury. So nobody will want to buy dollars or be denominated in dollars by owning Treasuries. So they need to keep inflation in check. So we only have 21 minutes, so I'll make this fast.
No, you're doing great. We still have plenty of time.
So what they're doing though is they know that they've got to keep in check, but they don't want inflation down to 2% really. They say they do, but not really. They want us to think it's at 2% because then it doesn't feel so bad when we're going out and shopping every year, and food, milk and eggs and steak or whatever, gas, everything is more expensive every single year. So more energy than gasoline. But so that's what they want to do, is they want to have us perceive that the inflation is not that bad. However, what they need is for that inflation to be above what the interest rates of the bonds are. Because the way that it works is that, and you and I have discussed this before, is that we have so much debt. We're growing and growing and growing. Well, we can circle back to that. But what they need to do is they need to inflate away that debt.
Right.
If you have negative real rates, your GDP is growing.
Right.
Your tax base is growing.
Right.
And so you're taxing more dollars to pay. So you're taxing these cheaper dollars because they've inflated to pay down old debt. And it's just, they're going to keep perpetuating this for as long as they can. And it can go on for a long time. I'm not out there saying that the dollar's going to collapse or Treasury's going to collapse tomorrow. I just don't think. I think there's a tremendous amount of confidence in these currencies, especially the dollar. So it's kind of where we're at.
Everything you said just made me think of an article I read recently called "Interest Rates: The Silent Killer," and you talk a lot about our mounting interest rate expenses on this growing debt. And I always think of you and Greg Foss when I hear do the math. So you pointed out some of the math on stage at the Ski Summit. Can you talk us through that a little bit?
Yeah, it's pretty simple. So the Congressional Budget Office puts out reports periodically. There was one last May, which I keyed in on a lot of our discussions, and then they just put one out a few weeks ago again. And so this is the Congressional Budget Office. Like they're looking at the numbers, they're looking at all of the expenses that we have, all of the programs, and they're adding it all up and putting it in a big balance sheet and in kind of an income statement. And so they add it all up, and when you look at what we have, what they expect in 2023 and 2024 for the next 10 years, this year, and remember that these are very optimistic projections. Okay, so basically you have three main components of the Treasury's their expenses and revenues, right? So you've got entitlements, which is like Social Security, Medicare, Medicaid, and you've got defense spending. So these are things that are either signed into legislation or they're long-standing contracts that they have to be paid with, like Lockheed Martin or Boeing or whatever, right? So they can't get out of these expenses. These are mandatory pretty much, right? And then you've got your revenues, which is your tax base. So they say revenues. It's not really revenues. They're just collecting money from our production. It's not their production.
Right.
They're collecting from our revenues, right? So, but anyway, so if you just look at those three pieces, well, if you've got your entitlements are $3.8 trillion annually. You've got your defense spending, which is about, right now they're saying it's $800 billion. We know it's more than that. Ukraine is stuffed in other channels.
Right.
Like we don't see exactly what's going on, but let's just pretend that that's what it is. So now you're at 4.6 trillion, right? They say that the interest expense on our debt is going to be $700 billion this year. But the Treasury just came out a few weeks ago and said they need to issue $932 billion of bonds this first quarter. So
up $300 billion from what they expected.
Exactly. So something is not adding up. And so we've had a cost of living increase for Social Security. We have a lower, like our revenues are decreasing, right? So they're projecting $4.8 trillion of revenues this year, tax collection. But we just added up everything, and it's over $5 trillion. It's about $5.4 trillion of expenses. But that's without the next problem, which is every single time that we retire a bond, it matures, a U.S. Treasury matures. Since we're operating in deficit, we're not making enough money to pay off those old bonds. What do? Well, we have to issue more debt
to pay those.
So you're paying down a bond that's maybe yielding 0.75% or 1.25%, but you're having to issue a bond that's yielding anywhere from 3.5% to 5%.
It's crazy.
So you've talked about this before. It's like, we're using our MasterCard to pay for our Visa. I love that analogy, and that's exactly what we're doing. But the problem is we keep running up this other MasterCard bill, and to the point where we have to take out another MasterCard. So there's no way out. If the United States, and you've heard me say this before, if the United States was a company trading on the New York Stock Exchange, it would be a zombie company.
Yeah.
Because we can't pay for our interest on our bonds with our revenues. It's just the math is the math. These are the numbers that are published.
Right.
And we know that they're worse.
Right.
They're worse because you think about the Congressional Budget Office, they don't do this in a matter of days or weeks. They take months and months to do these reports. So this is old data, they're old projections, and they're low. And so the revenues are projected to be too high, and the expenses are projected to be too low. And so when you actually go through the math, we're going to be at, I think, somewhere between $2 and $2.4 trillion deficit this year. So.
Wow. It really is crazy when you see those ticker numbers of the 30 trillion debt that's funded and then the 170 or 80 trillion unfunded. And it's like, we really have had such a privilege being the world reserve currency to be able to do this. But I can't imagine why other countries wouldn't want to create other systems, because how can you continue to go into debt and just perpetuate what you believe to be right across the world? I think other countries are going to say, well, we're going to build our own systems. We've got the commodities, so.
Yeah, that's exactly right. So you're seeing with Russia, they're keeping their oil in the ground. Mark Moss and I were talking about this just the other day. And they don't want the U.S. dollars. Why? I mean, because we can turn off their SWIFT system. We can seize their treasuries. Why would they want those?
Exactly.
They don't. They want the oil in the ground. Lynn Alden put out in one of her newsletters recently, she did some research on this, and she said that 1 barrel of oil in 1913, if I remember all the numbers correctly, was 95 cents. Okay? Flash forward to today, 1 barrel of oil is about $80, right? Mm-hmm. If you were going to buy 1 barrel of gold, or if you were going to buy barrels of gold with 1 ounce of barrels of oil with 1 ounce of gold, then you would, in 1913, be able to buy about 22 barrels with 1 ounce of gold. And today, with 1 ounce of gold, you can buy about 24 barrels. So,
wow.
So the problem is obviously the dollar.
Right.
Who wants to own dollars
right.
for their oil? Nobody, right?
Yeah.
So, and that's why you've got the BRICS. You've got Brazil, Russia, India, China, and South Africa. They're all kind of banding together to try to figure this out, using their natural resources and avoiding the dollar as much as possible.
Yeah, this is information that I think, we need to get out to everyone. And I think you do such a great job, again, with that newsletter, because unfortunately we don't have great financial literacy in this country, or education. So let's talk about a topic that I've been curious about lately. Stock buybacks. I was tweeting at American Airlines the other day because I was just so frustrated. It just feels like there's no customer service anymore. There's no incentive to have good customer service. Mm-hmm. And you see these big companies that, by the way, always get bailed out by politicians and governments when, obviously they took bad risk. But they, instead of investing into capital and equipment and staff training, they're buying back their stock shares and their executives are making $50 million. And then you obviously see policymakers trying to tax that or trying to prevent some of that. And I think that it's very nuanced. It's not just, hey, this is corporate greed. The whole system created by our government is incentivizing, this bad behavior and malinvestment and rent seeking. So why don't you break it down for us?
Yeah. So, stock buybacks aren't inherently bad.
Right.
Okay. They can boost shareholder value.
Yes.
So, but how do they do that? Well, if a company has a bunch of cash in their treasury and they use that cash to go into the market and buy stock, they take that stock and retire it. Now there are fewer shares in the float, right? So same earnings, fewer shares, that's higher earnings per share.
Right.
So when investors look at stocks, for some of your listeners who may not be aware of this, they attach a multiple to that. All right. So they'll attach a multiple to that earnings. It's earnings per share. And so let's say that it's a 20x multiple. Well, then that 20x multiple on more dollars per share will mean a higher stock price. And that's just kind of the way it works if they're doing it properly. Right. But then you have companies like Goldman who just announced a $30 billion buyback. You have Facebook that just announced a $40 billion buyback. And at the same exact time, they are laying off, the two companies combined are laying off 14,000 employees. So just think about it. So they're not going to use their cash to invest in their employees and pay them and keep the business going. They're going to use their cash to buy back stock for the investors. Okay.
Right.
Well, there's arguments around that.
Right.
All right. Let's just put that over there. You can look at that in a lot of different ways. The bottom line is shareholders own the company. They want value in the company. And so if you're going to retire shares to give them value, that's one thing you can do. Some of the bad practices in this world are like Best Buy, for instance, and so I talk about all this in the newsletter. If anybody wants to go back and look at the numbers, but in Best Buy, they bought about $2 billion worth of their own stock over the last 10-ish years, right?
Did they use debt as well with these interest rate policies? Because they
borrowed mountains of debt.
Right, exactly.
So mountains of money through debt, and so their stock price is down 97% since then. Okay, so what went wrong? Well, maybe they should have used some of that capital to invest back in the business.
Exactly.
And enhance or utilize ways to optimize their business, right? But they didn't do that. All they did is they borrowed money, bought back stock. Why? To pump up the stock, to pump up the shares, or to hold them there. And it didn't even work because the business was dismal. It kept, it was destined for failure unless they restructured it, which they didn't. They just financially engineered, fewer shares. It just didn't work. And now they've got $2 billion of debt that they'll probably never get paid back.
Well, yeah, I mean, it's not surprising with a system built on credit, built on theft, that all of this is happening. And you're right, it is more nuanced because when you have a company like Apple that has a ton of cash, they have to do something with it, right? And you have to chase yield. And so it makes sense to buy back, stock. But there are so many instances where it really does feel like, come on, the company is going downhill, the products, the services are going downhill. No one gets customer service anymore. But hey, the executives are very happy and the price is doing well in the stock market.
Well, this is your point, right? Is that the executives get these pay packages, and the pay packages are tied to the stock and the stock price. So if they're out there buying stock and keeping it up, that might trigger an option package and put the options into the money for an executive. And the board and the executives are sometimes pretty tight, And so what they'll do, nefarious actors will go and they'll go buy stock in the open market. The board will approve a stock buyback. They'll go buy back that stock, right? They'll put it in the treasury. They won't retire it. And then they'll turn around and award pay packages to the executives and give them that stock. So you basically just took the cash, bought stock, and gave it to the executives. But it's obscured in the statements. It's sometimes in footnotes, and it's in these tables. And so unless you're an institutional investor, you're probably not picking up on it. And so that's an instance where stock buybacks are just they're not the best thing for the shareholders of the company. And they could have used the money to do a lot of other things, but instead of just taking that cash and giving it to the the executives, or awarding them stock options that may not be in the money, and that wouldn't achieve their objectives. Instead, they obscure it by doing a stock buyback, stuff in the treasury, and then handing it. It's sickening, but it doesn't happen that often. I want to make that clear, but when it does, it's just, yeah.
Well, it's really interesting to hear about all this. You're my first guest where I actually went over the 21 minutes, darn it. But that's okay.
Cut some out.
Final takeaways for all the people watching, seeing Bitcoin's price. I mean, there's so much happening. Any final messages? Yeah,
I would just say, I think that the economy is still teetering. I think the Fed is going to keep tightening. All eyes are on the Fed, and they're going to hold rates high enough that they're going to break something. I just believe that because Powell has said it a number of times. I have tools to get us out of that hole, but I don't have a tool to get us out of the hyperinflation hole. So he knows that if the economy falls apart, they can just print again. So I'll say I'm watching for signs. I think it's sometime this year things start to break economically. I'd be careful. I'm buying, at levels opportunistically. But I would just caution people: don't try to time anything, because when it recovers, it's going to be, I think, a V recovery. So
Bitcoin is inevitable. That's what we think. All
paths lead to Bitcoin.
Check out The Informationist, and if you're an accredited investor, check out Bitcoin Opportunity Fund. Thanks, James.
Thank you.
It's time to hear these messages from my partners. First up, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase, from Amazon to groceries to sprucing up your wardrobe, with Fold's Bitcoin Cashback debit card. And you can win free Satoshis every day, or even play for the chance to win a whole Bitcoin by spinning the daily wheel and the purchase rewards wheel. I have an alarm set every day so I don't miss out on spinning the wheel and earning free sats. And it's also a great app to get someone that is totally new to Bitcoin. So if you want to join the fun, head to foldapp.com/Natalie and get 10,000 in free sats when you sign up. CrowdHealth, a Bitcoin alternative to health insurance. Health insurance costs can be sky high today, and you essentially send money every month to a massive corporation, the health insurance black hole, as I call it. And if you don't need any health care, you never see that money again, right? But if you do need to go to a doctor, you end up having to pay even more out of pocket, especially if you end up as one of the 20% of claims on average that aren't covered. With CrowdHealth, you pay a small monthly fee that goes into an account that you actually accrue over time and is yours to use or keep if you ever leave. You can even save that money in Bitcoin. CrowdHealth is all about community, and the community crowdfunds everyone's healthcare. So if something does happen or you have a doctor visit, CrowdHealth will negotiate down the medical bill much lower than what insurance would be, and then the community helps you cover it. And in return, you help others cover their needs. For more information, you can head to joincrowdhealth.com/Natalie. And if you use promo code Natalie, you get 6 months for $99. All right, next up, iTrustCapital. iTrustCapital lets you invest in Bitcoin for your retirement with the tax benefits of an IRA. You can defer taxes on gains using a crypto IRA, or with a Roth IRA, you can withdraw tax-free at retirement. And here are some important things to know given the recent crypto contagion. iTrust does not lend against client assets. iTrust accounts are also FDIC insured up to $250,000 US, and iTrust does not hold customer assets or money. Assets are actually held between Coinbase custody and a custody platform called Fireblocks. And Fireblocks, by the way, underlies pretty much the entire industry. So if you're doing retirement planning and considering adding Bitcoin to your IRA portfolio, you can sign up for an account and get a $100 bonus at itrust.capital/Natalie Brunell. Thank you so much for checking out this episode of Coin Stories. Again, hit like on the video and make sure that you have those notifications on so you don't miss out on any new episodes. And I would love to hear from you. If you have suggestions, feedback, guest requests, please email me at natalie@talkingbitcoin.com. Thanks so much.